Hello, I'm Elliot Hack, Community Relations Associate at University House Wallingford. Before we start today's presentation, Ike Almo would like to share a little bit about our beautiful community and our speaker today.
Thank you, Elliot. As an era living community in affiliation with the University of Washington Retirement Association, our residents benefit from the partnerships developed with the University of Washington Schools of Nursing, Social Work, and Pharmacy to deliver innovative programs designed with healthy living in mind. If you are considering making a move to a retirement community, you are welcome to arrange a visit and explore everything we have to offer, including future health options and how our waitlist works. And now to the main event. We are pleased today to have with us Tom Cock and Don McDonald, who have joined us today to present on a timely topic, the science of retirement income. With interest rates at historic lows, it's almost impossible to rely on traditional fixed income investments for retirement income. Discover a better way to create a lifelong retirement portfolio and generate a decent income without complex investments or annuities. In this online presentation, Tom and Don will share how you can use an academic approach to make your money last for the rest of your life. Tom Cock and Don McDonald from KOMO's radio's Talking Real Money help people work with money honestly, comprehensively, and effectively. Together on their show, Tom and Don have talked with some of the world's brightest financial minds to help listeners better manage their money and investments. These experiences these experienced investments and experts own the fee-only investment advisory firm, Vestity. Thank you so much for joining us today, Tom and Don. Welcome.
Thank you very much. I'll turn my mic on this time. Works better. Hi, everybody. I'm Don McDonald, sitting in my studio in Florida, where it is actually sunny. Sorry. It's Seattle, Florida, very different. Over there's Tom Cock. He's my co-host on Talking Real Money. And today we're going to talk about investing, but investing as it should be, not investing as it appears to be, at least for most people. This is a class we created recently called The Science of Retirement Investing. It's actually, let me just start it here. No, I'm not sure what you can see. Can you see the two screens or the one screen, Tom?
I'm seeing two.
I gotta fix that. Yeah, see, that's in the wrong mode. Just why I have to go in and fix that. It was on the right mode before, and then it changed. So let's do it again. Hit play again. Oh, now you have one, right?
You got one, man.
Much better. Now it's called The New Science of Retirement Investing. And what sets retirement investing, real retirement investing, the science of retirement investing, apart from all of that other stuff that passes for retirement investing is the fact that it's based on a lot of great research. That's why we have a little test tube guy there. Tom and I host a show called Talking Real Money. It's you can listen to it on KOMO on Saturday afternoons from noon to 2. We also host a podcast called Talking Real Money that's on all the best podcast services out there. As mentioned, we started a firm called Vestity back in 2009, a fee-only investment advice firm in the Seattle area that has now been merged with a company, the national company called Appella Capital. So we're now part of a bigger national firm, but still providing the same kind of services as we provided before to our local investors. So let's talk about investing versus real investing. We saw a lot in the last week or so about something that passes for investing, but it's not real investing. There's a big difference, and the difference is the academic research, the science of investing. It's truly simple. Investing is so simple. It is a balance of risk and reward. What we want is different than what we actually get. When we want high rewards with little or no risk. But the reality is, I'm not sure why it's clicking that way, but I'll do it with my other. They're tied together. If you want high rewards, you need to accept high risk. And if you want low risk, well, you can't make much money. But we don't like that. But we have to accept it. And it should truly be one word. The word should be risk reward, because risk and reward are so tightly entwined with each other, they cannot be separated. And we can see that in a chart of the performance of various assets over the past 94 years, 95 years almost. Inflation, a dollar adjusted for inflation became $14 from 1926 to 2019. Treasury bills to 21, long-term bonds, government bonds, $142. But if you took the risks of the stock market, that $1 by 2019 would have grown to $7,000. Oh, but if you really took risk and you put it in US small company stocks, that would have grown to over $20,000. If you want to make more money, you take more risk. If you don't want risk, you have to accept you can't make a lot of money. And by accepting the science of investing, you don't do dumb things like a lot of people did. And I should, in that blank, put in GameStop. Oh, why did I buy GameStop at $350 a share? That's not investing. That's gambling. Remember this company? It was hot. It was paying a great dividend. It was supposed to be one of the very best energy companies in America. Many of the financial magazines named it the best stock to own in America. It was recommended by analysts all over the country until it wasn't, and it went bankrupt. Buying individual stocks is incredibly risky, incredibly risky. Trying to time or predict the market, following these squiggly lines, doesn't work. There is no evidence that it works. In fact, there's a ton of evidence that it does not work. And remember, since we started keeping track of US stocks back in the 20s, equity prices have risen steadily. They've had times when they go down in here, but the overall trend is up. Now, we can't just focus on the S&P 500, which is what that chart showed us. We have to consider all of these other asset classes because they're all out there and they've all made money. As a matter of fact, many of them have made even better money. Tom, there are how many asset classes would you suggest people have in their portfolio?
Yeah, I think every investor should have their money exposed to 10 asset classes. So that includes, and I'm not going to go through all of them, but splitting your money between US and international stocks, having large and small in each of those markets, having growth and value for both large and small, having exposure to emerging markets and exposure to REITs. And because in this country, most of the attention gets paid to the Standard & Poor's 500, which is the 500 largest companies, people have a tendency to forget that they should own other asset classes. Don just mentioned small companies. And out of curiosity, we just looked it up a few minutes before we started. It seems like all the action's been about US large companies, but over the last 20 years, US small has made 9.8% a year, US large 7.4% a year. Our take is you own both of them because you don't know in a shorter period of time, 10 years, for example, which one will do better. But I think everyone should have some part of their money exposed to 10 asset classes.
And those asset classes, the big ones are stocks versus bonds, big companies versus small companies, value stocks, which are undervalued assets versus companies with growing earnings, profitability. Yeah, that's actually something that scientists, academics found improves your chance of success. So you want higher profitability companies. Longer term bonds are riskier than shorter term bonds. Credit quality determines the level of risk. A lot of people today are going out in search of higher yields on their investments. And what they're doing is they're stretching for yield by going into longer term bonds, which increases their volatility, and lower credit quality. They're going into junk bonds and the like, which increases your risk of default, of actually losing money in search of these higher returns. And there are better ways to do it. And we're going to talk about some of that. The other thing we ignore in the United States, we think we are the world. And economically, we are pretty darn powerful. But the United States does not represent the bulk of the global economy. Well, it does represent the bulk of it, but there's a lot of economy. There's a lot of other economic activity going on out there that you need to be a part of, because that other economic activity can bail you out when the United States hasn't been the best market in the world. And by the way, if you look at this kind of confusing chart, you look down here, the US is down here at the bottom. This is the best performing market in each of these years. In 2004, were you heavily invested in Austria? That was up 71%. Or in 2003 in Sweden, that was up 64%. Or how about Norway in 2009, 87%. You notice the US has only been the best in a single year over this entire period. And we would have missed out on all these other gains if we didn't diversify globally. As a matter of fact, this was what I was talking about. Remember the lost decade? That was 2000 to 2010. The Standard & Poor's 500 index was absolutely flat during that period. Its actual net return was just a tiny bit negative. Yet, if you'd had a portfolio that was 100% S&P 500, you would have made no money. Whereas if you had a portfolio that was globally diversified, you would have almost doubled your money. Small loss versus a pretty substantial gain. That's why we believe you have to diversify across all of these various asset classes. And doing so reduces your risk. And this is something we spend a lot of time trying to help you understand, or help our clients understand. Those same investments for over the last 20 years, an all US portfolio in the S&P 500 went from $10,000 to $31,000 over that 20-year period, whereas the international portfolio with bonds in it, by the way, 40% bonds, 60% stocks, came darn close to matching the S&P 500 over that 20-year period, but it did it with substantially less risk, as reflected by a number called standard deviation. And standard deviation is the variation, the volatility of something. If an asset class or a stock or whatever it might be, a bond, doesn't move at all, it has a zero standard deviation. The S&P 500 over that time had a standard deviation of 15 versus 10 for that globally diversified portfolio that included high quality bonds. Diversification has reduced risk dramatically. Hold on, I want to make sure I had this. I thought I was going, yeah, there's the slide. I want to show you this. These are the various markets, or the various portfolios that we have taken a look at over multiple long periods. This is from 1970 through 2019. If you had 100% of your money in fixed income in bonds, a U.S. diversified portfolio of high quality U.S. government bonds, you would have had an annual return of about 5.5%, 6%. The standard deviation, 4%. Your worst 1 year would have still been a loss of 3%. Your worst 5 years, you would have had a loss also. If you added just a little tiny bit of equity to that portfolio, your standard deviation remained the same because they didn't move at the same time. Your annual return jumped up to 6.6. Your worst year was very close. And your worst 5 years, again, because they don't move in lockstep, was actually positive. And we'll just go along the way, adding 20% stock, 30% in stocks. This is globally diversified, 40, 50. You notice when we get to 60 now, because of the addition of the equities, your return is way up to about 10%. Your standard deviation rises, but only to 9.4. You would have had to suffer through a worst year in that period of a loss of 29.9, almost 30%. But that's a far cry from the worst year of 50% with 100% in stock And here's the S&P 500 over that period. This is with all of those various asset classes, Tom.
Exactly. That's what I was going to say. So that's the stock side. The first number is a diversified portfolio of about 13,000 companies. Most people we see, just saw a guy last night who came in with his portfolio. In his IRA, he had 6 stocks. Six
stocks?
6 stocks. Don't say that fast. I mean, the
That is
problem
not
with that,
diversified.
yeah, if something goes wrong with one of those, you're in big trouble. And there's no suggestion that you will pick the right ones to do better than just being exposed to global markets. So again, this is the stock part, half US, half international, half big, half small, half growth, half value, truly globally diversified. And then the other part is the safest bonds that we know of, US government, short and intermediate term. So the key for anyone before they invest $1 is to decide how much volatility they can handle. And that's the line there. You can see how much the loss in 1 year and what kind of return you're trying to achieve. Because I see a lot of people that say, well, I just want to make all the money I can. And my take is, well, why? You're retired or you're close to retired. Don't you want to have enough to sustain yourself for however long you live, and if possible, leave something to others? But trying to make all the money you can generally means you're taking more risk than you should, and that can lead to problems.
And the other thing that this illustrates, as Tom said, this is a portfolio. The equity side of the portfolio is 13,000 securities approximately. The bond side is more than 10,000 securities. So between those, you have massive diversification. If you had just, as that gentleman had, 6 stocks, can you lose 100% of your money? You can. 6 stocks can go out of business. Can 13,000 companies all around the globe, can they? Anything's possible. Is it likely? Very unlikely. And if they do, probably not going to be a lot of fun to live here anymore if every company on the planet went out of business. So in this portfolio, now your only risk really is that standard deviation, this line right here, that bright yellow line. And the S&P 500 is a standard deviation, in this case, of 15.1%. A balanced portfolio has a standard deviation of 9%, 60% stock, 40% bonds. Look at the average annual return for those two portfolios. Most people are happy with the S&P 500, but the volatility scares them. Whereas had you had a balanced portfolio over that time, you would have had almost exactly the same return with a lot less bouncing around and a worst year that was dramatically better. Diversification ends up paying off.
We find that most people that we know are somewhere in the middle of that rather than being at one end or the other. Sadly, a lot of people we meet with are at one end or the other and don't know which column they should belong to. That would be the first part of any investment, financial plan, retirement plan, would know what rate of return you need and how much volatility you're willing to accept. Once you've decided that, all the rest of the stuff that you hear about in the media every day, and we love talking about on the show because it's fun, but it has no long-term impact for you as an investor other than entertainment and change of administration, problems in China, all these things that are coming at you. That's part of the noise, and the key for any investor is to have the plan and stick with the plan through that noise, which is going to come all the time anyway.
Well, and that noise is what leads to this. If you look at this chart, inflation over the past 20 years has averaged about 2% per year. A company called Dalbar studies the performance of all equity mutual fund investors in America. They look at how they performed by their buying and selling habits, when they get in, when they get out. And based on that, they determined that the average equity mutual fund, stock mutual fund investor over the past 2 decades made about 4.25% per year because of our propensity to panic when we hear bad things and to leap in after prices have already risen dramatically, like all the poor souls who got into GameStop at $350 a share. The S&P 500, just the S&P 500 over that same period made 6%, Whereas if you were in a balanced portfolio, US and international, you would have made 6.19%, 8% with a 100% global equity fund. This shows you that investing is really hard for us to do. Look at this line right here. When left to our own devices, investing is really hard. And that's why we think it's so important that not only do you have a plan for your investments, but you have a plan for your investments and an income and the income they generate in retirement.
You know, and this is a key part of the work that we do, and certainly the work that any financial advisor should do. And part of it is all these things you see here. How much do I need to retire? What kind of investment? People have a tendency to want to go to that part first, the sort of the dessert. And I'm always saying, no, have the hors d'oeuvres first, work your way through dinner, then get to the sweet stuff about how to invest, what stocks I'm going to own, what all that. So again, for us, and I think for you, especially if you're retired, the planning becomes absolutely essential. Sources of income, whether it's Social Security, pension, all those things. That's one part of it. Your investments, how much you need to generate off of those and how to withdraw that money in the most tax efficient manner possible, which is again, something people forget. Location of assets in your various different portfolios. There's reason to hold bonds in one place, stocks in another, et cetera. And as I said, kind of that withdrawal strategy that is designed to make sure that you and your significant other can sustain yourself for a very long period of time. Then
Tom, you muted yourself. There you go.
Then you move on to the exciting stuff, the investments. And by the way, we should have mentioned at the outset, we only use mutual funds or exchange traded funds. We do not use any individual securities. We do not time markets. We do not trust Jim Cramer and his ilk to tell you what's coming next, because nobody knows that. The work that we trust has been created by Drs. Fama and French and other academics who have looked at markets going back, in some cases, 100 years to say, this is how equity prices have performed for a long period of time. We think if you position your money this way, you have a good shot at making this much into the future. We don't know, of course, because after today, it's all a great mystery, right? We have no idea. But again, we think this is a good starting point. And again, we show you all these things. And by the way, I was going to mention that we've already seen the numbers from last year around investor behavior. It's abhorrent. If you remember last March, when the whole pandemic really became big, people sold out of stocks right and left after the market had already gone down dramatically in a period of about 24 trading sessions. We've seen the chart that shows all the money that poured out went into bonds or into cash, and then people started buying back in November and December after the market had gone up 30-40%, when the exact opposite is what you should have been doing, and we were doing for our clients. We were selling bonds that had gone up substantially and buying stocks that had gone down. We have no genius about this, but we have that thing that says right there, strict discipline. We know what our plan is. We're going to sell things that have gone up and buy things that have gone down to rebalance the portfolio. And we do not pay attention to whatever the crisis is, whether it's electoral, whether it's health, all of those things. They're here every day. Sometimes you hear about them more, sometimes you hear about them less. But a good advisor keeps you on the rails and deals with the behavioral part of all this. And Don and I, as longtime journalists, we're always surprised, because when I had my TV show, I'd give people a portfolio. When I was the host of Serious Money, I'd give them a portfolio and say, just go do this. Here's a few Vanguard funds, you'd be okay. I was always shocked when 5 years or so later, I'd ask people, well, how did it go? Well, I did it for a while and then the market went down, so I got out. Or Don had his national show, and in 2001, when we had the great crisis, of course, people called him up and said, I can't take this anymore, I got to sell. That was always a surprise to us until Vanguard did this wonderful work looking at investor behavior and looking what a good advisor should do. A good advisor, and we think you should use only a 100% fiduciary, someone who is a legal requirement to put your interest first. We think you should only use someone that uses mutual funds or ETFs. We don't believe in owning individual securities. And we think you should hire someone who is going to have a discipline and makes you stay to it. If we know nothing else about all this, it's that people have a tendency to try this for a little while. They have a series of ideas. Then I'll try this idea. I'll bounce back to here, here, here. And because this is what the future looks like. We don't know what the future looks like, but we know that a disciplined, low-cost strategy over the long haul has been the best way to go for investors in general. I'll put it that way.
And let me give you a really critical example of that. A lot of people believe without, and this happens because of lacking the proper guidance, that the best strategy in retirement for retirement income is to start selling all of your equities and to buy a portfolio of nothing but bonds or CDs or bank accounts. Well, in this day and age, that would leave you with an income of not much more than 1.5%, maybe 2% per year. And not a lot of people can survive on that. However, with the right kind of a plan, we have seen numbers going back as far as we have data that has shown that there's a thing called the 4% rule, that you can take out 4% of your portfolio every year, adjusted for inflation, and based on all kinds of academic simulations, not run out of money. Well, it turns out every single time they test that, no matter what the circumstances of the market, that holds up. It holds up well. And that's just one strategy, the 4% strategy. There's a flexible income strategy that we employees take out as much as 5% per year from their portfolio, but then they adjust it every year based on the value of their portfolio, making it almost impossible to run out of money before you run out of life. And that's that next to the last thing. Those income strategies can add return to you, and it's over and above whatever the cost of the advisors are. You just have to find the right one. You don't go to Edward Jones. You don't go to Ameriprise. You don't go to your insurance company. You don't go to Morgan Stanley. You don't go to Merrill Lynch unless it is a fee-only account. That is critical. It must be fee-only, 100% fiduciary, and they should be willing to put that in writing.
I think that's indeed true. And this is the firm Don mentioned that we founded over a decade ago. And by the way, for the 12 or 13 years before that, I was a partner, and Don was kind enough to be involved in a company called Merriman with our friend Paul Merriman, and manage money the exact same way. We know of no other way that we think is based on real science, that you can really look at the numbers. Many people call it evidence-based investing, because you can really say this is what's happened for a long period of time. Therefore, the future could look like this. We think it's the only reliable thing to count on, and everything else, frankly, is pure speculation. And you can see a lot of the speculation is there. We see it, we hear about it every day because people come in our office. In addition to the person with the 6 stocks yesterday, we talked to someone else who got caught up in a scam because they were trying to reduce their tax bill, and ended up actually getting money stolen from them because they got excited about the fact that they weren't going to have to pay taxes, which we see people do that. So, and all these things are regular stories. Sometimes they're big stories and you hear about them, like Bernie Madoff. Sometimes they're smaller, but those smaller ones can be very impactful. And again, that brings me to a couple of safeguards. I would only have my money held custodianed at a major custodian, period. I would not have it given to anybody else. I would never give anyone else the right to take money out for themselves. Our clients' money is at Schwab. We can only send it to Schwab. The only thing we can do with our clients' money is sometimes sell a mutual fund and buy another mutual fund, because you can see people do get ripped off, and they get ripped off more than directly. And this is something I know Don spends a lot of time talking about. They get ripped off by high fees. They get ripped off by active trading. They get ripped off by really lousy strategies. And Wall Street has a new strategy. Basically, they have about 10 or 15 new ones every week that they're excited about because they're going to make them money and not necessarily you. And here
I forgot I had the advisors up here.
Go ahead.
Look, there's you, Tom.
I know. I look a lot younger there. I think that picture.
Well, you were a lot younger there.
Sometime
we have teams of advisors, and one of the things we offer to everyone, we do it on our show, we do it on our podcast, is we believe that everybody should at least have the opportunity to spend a couple of minutes with a 100% fiduciary advisor without any obligation, any cost, or any sales pitch, period. No high pressure sales pitch ever. So we've been offering this for a very long time, and it's something no other firm does. The firm that we merged with is just going to start doing this because they went, oh, that's a really cool idea. Give people free advice. You know why it works? Because when you give people free advice and they have a friend who really needs to pay you, they often will say, you know, instead of asking me all about that, go ask those guys at Vestity. So we want you to seek out help. We want you to, one, listen to our podcast or our show at talkingrealmoney.com. We also have an online newsletter with lots of great information called Real Investing Journal. And for folks who have retirement plans from their workplace to see how those should be allocated, we have 401411.com. And then, of course, we have Vestity. And everybody needs help now and again. Everybody does. So if you are interested in speaking with someone, setting up an appointment to spend a little time with one of our fiduciary advisors, it'll probably be Tom who calls you. But just go set up an appointment at veststory.com. There's an appointment scheduler right there on the website, or call 800-386-3004. That's 800-386-3004. Oh, and that was the last one.
Can I add one thing here, Don? In 2 weeks from Saturday, so the last 6 years, we've done an event called Retire Meet.
Oh, I forgot to put that on here.
That's quite all right. So Retire Meet is a gathering of the best minds we know of in the business to talk about money, to talk about insurance, to talk about retirement income, to talk about Social Security, to talk about all things retirement. And this is something that we did many years in person in Bellevue and sold it out every year. This year, for the first year, we are going all virtual because we can't get 400 people into a room in Bellevue. And so if you go to Retire Meet, and that's either with 2 E's or an EA.com, you can register. It's 100% virtual. There's no cost this year. And frankly, we have some of the best speakers we've ever had. We have our friend Paul Merriman back. But we also have a guy named David Booth, who is a real pioneer in the financial services industry. Started a firm called Dimensional Funds in 1981. Hard to believe it's been 40 years. We find Dimensional to be one of the most reputable, one of the best mutual fund companies in the world. And they are, I think, the 7th largest in the United States that you may not have heard of because they're not directly available to the public. But that is all online. It's virtual. It is February 20th. Starts at 8 o'clock in the morning. There you go. Thank you, Don. And it's free, and you can go on whatever track you want. You can, as Don likes to say, you can show up in your pajamas and no one will care. So it's a pretty good deal. And by the way, one of the other great speakers we have is Tina, who's with us on this call. And Tina, thank you for inviting us to University House. And Elliot and Ike, thank you for all your help. Tina will be speaking about the great work that Tina is encyclopedic about all this stuff. I love the way she gets up and talks about all of your options for housing. So that caliber of person will be Herb Weisbaum from KOMO, talks about protecting yourself from scams. We're calling it Retire Meet America this year because it is America. We have over 800 people signed up, and more than half of them are from states outside of Washington. I think we're in 42 states and 3 other countries. So truly going to be, I guess, even Retire Meet International, Don, not just Retire Meet America. But
yeah, I didn't expect that.
Yeah, you'll enjoy it. There's always something there that people walk away with, or I guess sit away with this year and love. So.
All right. Now, did we get any questions?
It doesn't look like we've had any questions come in just yet, but
okay.
Tom and Don
They've
graciously offered their time. So if you do have any questions, feel free to send those through the chat box at the bottom right of your screen, or you can also email them to me if you're joining us by phone. Again, my email is elliot.hack@eraliving.com. And we'll wait and see if some questions come in the chat for a few minutes.
I'll answer the tough one first, Elliot. What people want to know what the market's going to do. So I can tell you that right now. I think I can tell you very quickly.
Oh, good. Yeah. What's the market going to do, Tom? I've been dying to know.
Pretty soon, the market, the Dow Jones Industrial Average is going to be up 286. So you got that to look forward to with your investments. So we don't predict markets.
It's up that much, right? It's up that much right now.
Sorry, yeah, I'm not a very good
Wait a minute.
predictor.
No, it's up that much. It was up that much just a few fractions of a second ago.
Which is something we do believe. We do believe that people should always talk about markets and returns in past tense, because they always are past tense, not what's happening or going to happen. It's what's already happened. So
I wonder what GameStop's done. You
how
want a
far
great
is that
story?
yeah,
Well, wait a minute. Wasn't it? It was like at $400 just.
plus 400.
Yeah, 400. It's now down to $59.91.
Wow. All those poor souls who jumped in, as you said, at 350. That's hard
Poor
to
soul. Poor souls.
Speculators.
Not, yeah, gambling souls.
Yeah.
Because that is pure speculation, playing those kinds of stocks. It is just crazy. Although now that we talked about it, it's up a whole 10 cents to $60. So 9 cents.
I guess that you're feeling bad for people pushing the price up a little bit. So
just shocks me that we keep doing this kind of stuff, even though we should know better. It's not like we haven't been warned, but I think we're good. I think we're done.
Yeah, I haven't seen any questions come in, so I think you must have covered it very thoroughly.
Yes.
Thank you all for attending. We really appreciate your participation. And remember, if you have any questions, you can always call us. You can call us with questions 24 hours a day on the show at 855-935-TALK. You can call either during the show or call with your questions and we'll answer them on the podcast. So listen to the podcast at talkingrealmoney.com or on your favorite podcast service, and listen to the show on KOMO Radio on Saturdays at noon. Anything else, Tom?
we are live on KOMO. It is not taped. We take every call. We don't screen anything. And we have a lot of fun doing it. And it's been a very popular program for many years. So we'd love to have you join us, of course.
#1 rated show among adults over 45 on Saturday.
All right. Well, thank you, Tom and Don. We really appreciate your time and the incredibly informative information that you shared with us. I know I learned something new, and I hope you all did too. And thank you, everyone, for joining us. We will be emailing an evaluation form to you, and we'd love to hear your feedback on this presentation, as well as any suggestions you might have for future Zoom presentations, both how we run them and also any topics that may interest you. We'll also be emailing a link to the recording of this presentation as soon as it's ready, well, most likely early next week. If you have any questions about University House Wallingford or would like a tour, please call us at 206-545-8400. Again, I'm Elliot Hack, Community Relations Associate here at University House Wallingford, and this concludes today's presentation. On behalf of Ike, myself, and all of us at University House Wallingford, where life goes on and lifelong learning thrives, thank you for joining us today. Wishing you good health and many returns.